Hi, I'm Jordan Bradford with Burkholder Wealth Management. I'm here today with our founder and CEO, Eric Burkholder, and I think we're going to talk a little bit about yield today and kind of how that plays into portfolios and just kind of go over some details on that. So, Eric, why don't you tell us a little bit about yield and what that is in a portfolio and why it's important?
Yeah, so it is important. It's often a very top thing people are looking for in their portfolio and investments, and very simply, yield is what cash is paid out of your investments.
Right.
And so that can come either from a fixed income or a bond type investment. And so that's, literally, coupons. Back a long time ago, they're called coupons because you would have like the certificate and you literally would mail in your coupon to get a payment back. They don't do that anymore. It's all electronic. But that's a set, amount that has been agreed upon in advance. That will come, assuming the company doesn't default, they will pay that till maturity. Or yield can be from a stock investment or a real estate investment, and that's typically paid out of the cash flow of the earnings of that investment. So they tend to be more consistent, but they can change depending on the company's circumstances, and they may pay special dividends if they've had a really good year. But ultimately, those are variable, and there's no contract telling you how much you'll get. But a lot of not developed, but mature companies tend to pay dividends.
Yeah, I think so. That tends to be more of your value-based companies, right?
Yeah,
as opposed to growthy companies.
There.
Although there is obviously, as you mentioned, there's some overlap where you may have a growth company that does pay a dividend, and you may have a value company that doesn't.
Right.
But I think generally they do tend to kind of filter towards that large value side, or at least the value side.
Sure.
So dividends, they play a role, but clearly there are some other things to consider as well. So what are some maybe drawbacks to designing a portfolio that's heavily centered on yield?
Yeah. And so the reason why people love yield is because obviously they see that money coming into their account. But specifically, and I'll use an example of stocks, if a company chooses to pay you a dividend, that company now, and say the company pays out $2 million of cash dividends, that company now has $2 million less cash.
Right.
Versus the identical company, say there's a competitor that's the exact same situation that did not pay out that dividend. They still have $2 million of cash sitting in their bank account. And so from an investor standpoint, or when we look at companies and say, what are their value, that company that kept that cash, which is now available for future investment, is going to be worth more. Just all other variables held the same.
Right. Makes sense. An asset on their balance sheet still.
Exactly, and that's why when a company pays out a dividend, that stock on the day it goes, there's X dividend, meaning all shareholders on that date will get the dividend. That stock drops by the exact amount of that dividend.
Interesting.
And so the perception that this is like extra money or it's somehow over doesn't affect the company, I think that's the idea, is this is just like extra money the company's giving me. It is actually affecting the stock price of that company,
right? And
it is at least temporarily going down by the exact amount of that dividend. And so I think that is one major misperception of dividends, is that cash flow is not somehow affecting the company. It is. Right. There is a trade-off.
Yes, it's not a separate. It's not a separate event that has nothing to do with the share price. It actually coincides directly with the share price and does impact.
Exactly. And I would say on the fixed income side, the most common misperception is, not misperception, but maybe just misunderstanding is, as long as I hold that bond and I hold it till maturity, I'm getting all my principal back and all those interest payments. Now that is true. The reason why I call it misunderstanding is because it's not recognizing a lot of other risks.
Right.
One is interest rates change, and so that bond now may be paying you lower rates than what it is in the market, which means that bond that you own will go down. Even if you hold it maturity, now you're missing out on reinvestment opportunities, and so there's risk to holding a bond just to get the yield as well. Ultimately, we are told to return investors.
Right.
And the reason why total return is so important is because a lot of opportunity lays outside of companies that are paying yield. Only about 5% of companies in the world have a dividend.
Interesting.
So if you really focus your portfolio on only companies that pay a high dividend, you're missing out on a lot.
Right.
I think a great example, even though Apple does now pay a dividend, if you were to ask any investor, hey, would you like to own Apple, starting in the year 2000, I think most people would really like to have Apple as part of the portfolio.
Yeah.
But if you only held companies that paid dividends, you would have missed out. And there's many, many other examples of fabulous companies that don't pay dividends. And so what you end up with is, if you're only focusing on yield, a portfolio that's very concentrated. Banking and financials tend to pay yield. Real estate or REITs do. Utilities pay a high yield, and so MLPs was another one. So you end up with these portfolios that are very concentrated in risk. And so that's what we care about a lot is risk, and then also total return. And so there's different ways you can get return, and you want to make sure you're diversifying that across different sectors, different markets. And you can't do that if you only focus on yield.
Right. So I think the message really is, yield is great and it's a valuable tool for a portfolio.
Yes.
But like anything, we want to think about moderation and understanding that you don't want to have just a yield portfolio as well as you wouldn't want to have just a growth portfolio.
Right.
You want to have a mix of a lot of different asset classes so that when a 2020 comes around or even a 2022 where the market is pretty volatile, you have some different investments that are performing differently and some providing returns when others are not, and then vice versa.
Right.
I think too much concentration and is, especially with only 5% of global stocks paying a dividend, having all of your stocks pay a dividend or all of your equity positions dividend payers, you're missing out on 95% of the market. And right. I think that we can miss out on a lot of potential return as well as a lot of potential risk mitigation if we just focus in on 5% and exclude everything else out over one particular facet of a company.
Right, exactly. And there's risk to dividend paying companies just as there are to non-dividend paying companies.
Right.
I think the 2008 number, and don't quote me on this, I'm in the ballpark though, is I think 50% of companies either reduced or eliminated their dividends in 2008, 2009. So, you still felt that the 2008 financial crisis very severely, regardless of whether you only held, dividend companies, because a lot of people think, well, at least if the stock price goes down, the dividend's still there. That is not necessarily always the case. And then the flip side on fixed income, we really want to balance future spending versus spending now.
Right.
And so typically the higher yield instrument you own, you're getting cash flow now and you're sacrificing that for future cash flow.
Right.
And so when we work with clients, we care about them now, but we care about their future self as well.
Yeah.
And oftentimes we are more concerned or more focused on that future self than they are because, we're all human. We're really want to make sure we're protected now.
Right.
Part of our job is to balance that over your entire life. And so if we focus too much on yield, which is really protecting against current spending needs, we're really potentially risking our future spending needs. And so we have to have a balance. And that's our job, is to make sure the right balance is there.
Absolutely. And I think there's a lot of different types of yield. There's a lot of different ways to generate yield in a portfolio. So I think, taking a diversified approach and looking at all angles is really important, and not getting too caught up in I really like this company because they pay a dividend. I think even if you look at a specific example of any one company, you also want to look at, are they paying their dividends out of cash flow or cash reserves? Because it's not a requirement that a company is making money to pay a dividend.
Right.
And that's, potentially dangerous if you have a company that's maybe has negative earnings and they're still paying out a dividend. That could potentially be doing more harm than good for the company itself. Maybe the shareholders like that because they're still receiving their income, but it may be causing more problems down the road for the company. They're kind of kicking that can down the road, if you will.
Right. In living in Tulsa, Oklahoma, we are in the oil part of the country, and so this hits very close to home. But MLPs, which is a certain type of tax structure, but most of them tend to be oil and gas companies, are the perfect example of very high yielding vehicles or company structures. 8, 10%, double digits at some point. But I've had a really poor run, and at some point, I think they even hit a 15-year time frame where they had a 0% total return. So if they were paying out 8% dividend yield, the value of those companies was losing 8% yield.
Right.
And so it may have felt like you were making something, but at the end of the day, you made nothing. And so,
and if you're not reinvesting all those dividends, you actually have less value than you did before.
Correct. So, like Jordan said, dividends yield are important. Interest off of fixed income is important, but it's only one piece. Vegetables are great, but I cannot live on lettuce alone. I think most people can't. And so, we never want our portfolios to get too tilted in any one direction.
It's a balance. We want to keep everything balanced. We want to keep your portfolio in balance, keep your life in balance. And I think that anytime you start diving into one particular asset class and forgetting that there's a world of investments out there, you can very easily lose out on return or risk that you're trying to avoid or acquire.
Yep, exactly. So we could talk for probably hours on total return, dividends, but the purpose of this video is just to give a quick primer out there to anybody. So as always, if this piqued any other questions or interest, we're happy to answer whatever questions are out there, and then. Just shoot us an email, give us a call, and otherwise we will see you on the next video.
Thanks.
See ya.